everyone, a very good evening to everyone. I hope you all are fine and doing well. So, in today's class, we are going to start module B, and in this, our first unit name is Risk and Basic Risk Management Framework. In this chapter, we are going to learn about the risk and the basic risk management framework. Let me introduce first what is the basically this module is, then we will moving further. So this is our module B, that is risk management. Okay, in this module you will learn different types of risk in the banks, different types of risk in the banks, and apart from this you will learn a lot of strategies here, strategies to deal with these types of risk, and other things you will going to learn in this module B, that is what are the committees who are responsible to manage these type of risk, and what is the meaning of actual risk, how many types of risk are there, like operational risk is there, like we can say liquidity risk is there, then apart from liquidity risk market risk is there, sorry, credit risk is there, and so many risks you are going to learn in this module. If I talk about the importance of this module is very important module. After module A, module B is one of the important module in BFM, and you get lots of question from here. And if I talk about the you will see the numericals. Yes, in this module there are lots of numericals, and also you will see the concept of haircut in this important concept. You will see the concept of LCR, NSFR. These are the concepts which are very important for our examination. So I must say this module is also a important module, and lot of weightage it is having in the examinations. So let's starting with our first class of this module. And in this, before going to start, before going to know about the risk management, first let's learn about the risk. What is risk? Obviously any type of possibility of losses due to some events is called risk. This is a possibility that things would not turn out the way we expect them to, and what we achieve is very completely different what we planned or what we hoped for. This happens because of lots of uncertainties. Uncertainties means we can't predict the things. That is called risk. We can say the risk, but uncertainty and risk, these both are the different terms, and you must know what is the difference between of these two terms. We will learn this in the upcoming slides. So we can say risk is that thing which is that possibility of the losses that we can't expect. Okay, now if I tell you the uncertainty, what is the meaning of this uncertainty word? Uncertainty is a wider concept if we compare it with the risk. Uncertainty is what? The things that happened, we even uh, did not plan anything for this, and even we can say we even don't expect about the uncertainty. In the means that type of situations or the events which are not predicted, which are not known by anyone, and this is what basically we don't know about the future, what will happen in the future. But risk, we know that type of situation can come in front of us as a when we are working in a bank. So we have some planning strategies to how to deal with this type of risk. So risk, we can say we know in advance, but uncertainty, we don't know what will happen in the future. So it is a situation where the outcome is unclear or vague. We don't know about the situation. But risk is a type of uncertainty that can be happened, that can be measured, understood through the probabilities. So risk can be estimated, managed, because we can predict possible outcomes and their likelihood. But uncertainty is not predictable at all, and also we don't know what will happen in the future. Fine. Then in business or the investment, uncertainties affect the net cash flow, meaning meaning how much money comes in and goes out, we don't know. But uncertainties can cause cash flows to vary, something leading to the higher profits, or in some cases there are some losses too. The potential for the losses or reduced profit, what we call this is risk. When we know what will happen in the future, we have the idea of the losses or any unwanted event, that is called risk. And uncertainty is a wider concept than risk. In this uncertainty, we don't know what will happen in the upcoming time, or any sudden situation that we can't expect it. Okay, so if the business or investment has more predictable cash flow, then the risk is lower. Obviously, we know the things and we know how to tackle these type of situation. Means business is less likely to experience big changes in profit or loss, and the potential for both higher profits and higher losses is smaller. And lower risk means there is less type of variation in the cash flow, little bit changes and the little bit variance in the cash flows, which leads to the lower profit and lower losses. So the condition of high risk, we can say, is problematic, but lower risk means less variation in the cash flows. Okay. Fine. Now, most important, trinities. Here, the question can be there from this topic. Linkages between risk, capital and return. Risk, capital and return, they are very interrelated, and they are the core from the of risk management. Let's consider there is a person who is trading in a stock market. If the trader makes the profit adds to their capital. But if trader makes a loss, it does not have any backup funds where they will cover the loss. This is why before starting to the trade, the trader needs some money or some back support capital to protect themselves. This backup capital helps here. If the things are not according to the planning, then this type of we can say money or the capital or anything we can say can cover the profit. Okay, so that is what risk, capital and return. Fine. Linkages between risk, capital and return, you can say these three things are related to each other: risk, capital and the return. Clear this thing? Now moving forward, what is RAROC on capital? Risk adjusted return, a key factor for the investors when they are making the investment decisions. And while we doing the business management, the main goal is here just to improve the RAROC. RAROC helps in measuring the performance of a business units like branches or the departments by taking into the account the level of risk they are taking to achieve returns. The higher the RAROC, the better the return for the investors or the shareholders, and the more attractive the investment will be to the market. So we can say that RAROC is that much important concept for the banks, in which we can say that a key factor for the investors when they are making the investment decisions. And in the bank management, business management, main goal is to improve the RAROC. And ROE, what is the meaning of ROE? It is calculated with the help of the financial statements. And In this does not account for the risk in the revenue model, making it less useful for the investment decisions. A business capital needs here and the expected returns, they are dependent on the level of risk, and this level of risk is associated with the operations. If the risk is high, the business will need more capital and will also expect higher returns to compensate for the risk. Similarly, if the businesses are there with the low risk, require less capital and expect the lower returns. Fine. Why we require that risk are going to be managed? Why we need that risk are going to be managed? Why it is important to manage the risk? See, if I say about the risk, risk basically impacts overall business. Okay, risk is that thing we can say that impacts a business or a investment, and there is uncertainties which affects the cash flow, and these uncertainties can cause the cash flow to vary, which result in either gains or losses. The risk in a business is the possibility of these negative outcomes, and it is very important to understand that the size or impact of the risk is not fixed. It's changed depending on how severe the unfactors are here. So risk, why we have to manage the risk? Because risk is that thing which causes the loss. So first thing, we have to identify all the risk, then we have to measure all the risk, then we have to analyze all the risk, then we have to make the proper strategy to mitigate or to manage these risks. That's why risk management is one of the important concept in the bank's context or in any organization context. If we ignore the risk, this will cause the bank failure and even the insolvency of the bank. So that is why bank risk management is very important things. Then risk management involves that all the possible factors by which we can manage the risk, and by which we can do the management of the risk. All the risks are needed the management, a good management, and in with the help of risk management we can do the things properly, we can run the operations of the bank smoothly. So that's why a good risk management is important. Some of the basic risk management framework. First one, top management, board of directors are included here. They are responsible for implementing that policies, they are responsible for making the policies for the risk management, and also they are responsible, they are work like a leaders, they will lead the bank according to the guidelines of the top management. The entire bank will work. So board of directors are one of the important thing, and you know that risk management is one of the important responsibility for the board of directors. They will make the changes according to the needs of the bank, and they ensure that risk management and business policies are implemented consistently. So best practices we need, best strategies we need as a bank to manage everything properly. And I already told you, identification and measuring of risk is very important in a management. In for a good management, we must know how to identify the risk, what is the cause for that risk, what is the consequences of this of that type of risk if we ignore these risks. So these things are very important. Risk management starts when we identify the risk and when we find the measurement, how to measure these risks and how serious these risks can be. Once we understood these types of risks, then we can take the steps and the action how to mitigate these risks, so there is no a big loss for the banks. So these things include in this. Then obviously a risk management committee is there, board of directors are there, senior management is there, elco support is there, auditors are there, who are working together just to make the risk effect lower. And for this thing, obviously we need special skills and separate setup. Risk management requires specialized knowledge and the skills. And what is the role in this? It is focused on controlling the risk to ensure that everything runs smoothly. For this reason, risk management needs its own dedicated team without outer influence, or they are dedicatedly towards how to do the management of risk and structure within the organization. That's why if we talk about the organization for the risk management, there are four stages. First one, board of director. They are responsible for everything. They are responsible for making the policies, procedures, and overseeing the all over the bank. They need updates from all over the bank. They are like the top management. Then risk management committee of the board, now they are making implementing the policy. They are directly reporting to the board of directors. They are creating the procedures, they are creating the guidelines, they are monitoring the risk, they are watching everything. Then ELCO, Credit Risk Management Committee, Operational Risk Management Committee. The work of these committees is just to see that the policies by the board of directors are implementing properly in the banks or not. If there is any issue, they directly report to the board of directors. The work of these committees to it makes the strategy and get approval by the board of director. They are working on only that banks will not face any type of risk that cause the high losses to the banks. This sets the limits that how much risk bank can take, willingness of the bank to take the risk, because we know that there is a direct relationship between risk and reward. So we have to take the risk if we want reward, so there is a direct relationship between them. So they set the limits. This limit is in official terms called risk appetite, means the willingness of the bank that the bank will take the that much of risk, that is risk appetite. Clear? Then risk management support group is there, basically who works with the all three are mentioned above. They are working with these committees or these board of directors and risk management committee of the world. They make reports and submit it to the board of director. They will do everything that everything is runs smoothly in the bank. If there is any problem, they come and do the reporting to their top management. Then top management will take the action according to the problems. Okay, so subgroups, you can say, they handle all the implementation of risk and business policies. ELCO committee, they see the bank's liquidity risk, they monitors and they improve the bank net margin, interest margin. They recommended some interest like BPLR, MCLR, RLLR to the board. They monitors the treasury operations in real time. Then ORMC, they ensures that everything, every operational risk is managed properly. As we know that operational risk means these risks are comes from the internal staff. Okay, they train the staff, they tell the importance of risk management to the staff. They analyzes all the fraud cases. They suggest the ways to how to prevent from happening these things again. That they trained every. So yes, S Kumar sir, banks give training to their staffs, and also they already hired the staff who are already know about risk, and they all who are already know the importance of risk management. But in some cases, they banks also train their staffs too, if required. They train the staffs too. Okay, and also they approves the new products or the processes and other than credit related ones. Then risk management support group, this is basically headed by the chief risk officer, usually a senior level like general manager, and this CRO is supported by a team of skilled professionals, and they are managing different areas like asset liability group, mid office group, credit risk group, operational risk group. They handles operational and other residual risk. They everything, they monitor like every type of risk. So we can say that risk management support group department works for the risk management. Then risk identification, as we know that there are different types of risk. Liquidity risk, when we are unable to meet the obligations of related to the cash. Interest rate risk, when there is changes in the constantly changes in the interest rate risk. Market risk, when there is a risk due to the market factors, changes in the market factors. Operational risk is like internal error. Due to these internal error, these type of risk is happened. Credit risk, default risk, is a type of risk when a borrower fails to pay the payment, or the loan amount, principal amount, interest amount, EMI, we can say that. Okay. So liquidity risk, when the deposit will be paid back in 3 years, but the loan will only be half repaid by that time. So if the bank does not have the enough liquidity cash, they cover this gap, it faces the liquidity risk. And if the borrower defaults on the loan, the bank also faces the time risk. Management. Risk management is also important, as I told you. By the help of risk management, we can understand that how much uncertainty is available in the market and how they affect the market values, losses due to the factors like defaults. Everything should be managed when we are doing the risk management. And good risk management give the banks a long term success, and poor risk management can become the cause for the bank failure. So very important to understand these types of these types of measurements, and how to measure these types of risk. And risk measure are usually divided into three main categories, based on the sensitivity, based on the volatility, based on the downside potential. Volatility means how much changes are there in the stock prices or the earnings. It means stability or instability of something, showing that how much value moves up and down. And the statistic volatility is usually represented by the help of standard deviation. And there is a formula of the volatility. You can see time horizon is equals to daily volatility multiplied by square root of t. This is the formula of computing the volatility. Downside potential, it means the risk of losses which only happens when earnings move negatively. That is the we can say downside potential. While volatility measures both upward and downward movements, downside potential focuses only on the negative side, because it represents possible losses, not profits. It looks at the negative changes in a target variable. Now risk monitoring and control. Risk monitoring and control means they are the key parts of managing a business, especially when we are going to aim how to improve the risk adjusted return on capital. Basically risk monitoring means carefully monitor the risk, and then taking the proper actions to control that risk. And effective risk management is not done in isolation. They are happened with the while achieving the business goal. They are risk monitoring and control and the management works simultaneously, helping in implementing the risk and business policies in a consistent way. And the goal is here to achieve the best return while keeping risk within acceptable limits, giving the available capital. Means within the capital and the acceptable limits of the risk levels, everything is in limits. And still here the way to get the best return, that is called, we can say, goal achievement. Risk mitigation means the all the strategies how can we reduce the effect of risk is if there is available, and all eliminating all the uncertainties that causes the risk. In a trading business, one could enter into a sale contract to lock in the price and the quantity or the goods being sold. This reduces the uncertainty about the future prices. Okay, like a purchase contract would reduce the uncertainty about the buying price. So other option is to sign a contract, transport provider to ensure that goods are delivered, minimizing risk related to the transportation. Then EWRM, a very comprehensive approach, and this approach is usually for the banks and financial institutions who can achieve their goals by just managing the risk effectively. Organizations are facing many challenges, and EWRM is that concept which helps in identifying and helping in identifying and managing these types of risk. And there are one more thing here, that is four key business objectives. First one is strategic. In this we have to achieve the long term goals. Okay, so basically strategic goal is of the business, like to everything runs in a long term. Then operations means running the business very in effective manner. Reporting means every report should be done to the board of directors, so the accurate financial and operational reporting that the board of directors will update are updated with the ongoing processes, ongoing things on the bank in the banks. And compliance means follow every rule and regulation. So this is important. So ERM is helping business identifying the risk and choose the best ways to respond to them. And it also ensures compliance with the regulations, protects the company reputation, and make sure the organizations run smoothly constantly in the changing global economy. So that is it in the today's class. We covered quickly chapter first chapter of the module B, and if you have any problem you can do the comment. I will address your query. So that is it from my side for today. So I hope that everything is clear in this session. So we will start next chapter tomorrow with some new concepts. Till then, take care and have a good day all. Thank you and welcome.